Assalamualaikum and very good morning to you all. Today I would like to present about the risk and return for single asset and capital asset pricing model CAPM. But first of all, let me introduce our group member first, which is I as Noliana binti Azman as the first presenter, and the second presenter is Nur Shafina binti Muhammad, and last presenter is Dayang Liana binti Hashim. So I hope you all will enjoy with our video and presentation. Okay, before we start the lesson, let's we pray for Umul Kitab Al-Quran first. I'm pretty sure that you all must know what is risk and what is return, right? So I'm here not to talk more about what is risk and return. As I mentioned just now, our group more focuses on single asset and the firm. So this is a characteristic of individual securities that you guys must know. There are five of them. First is expected return, second is a variance, third is standard deviation, fourth is a covariance, and last is a correlation. So remember, you must remember all these five as a characteristic of individual securities. Okay, don't worry, I will explain more about it one by one later. Expected return. What is expected return, guys? Okay, first, return that an individual expects the stocks to earn over the next period. Remember, the actual return may be either higher or lower. Okay, higher or lower. Second, expectation may be simply the average return per period a security has earned in the past. It may be based on a detailed analysis of a firm prospect on some computer-based model or on spatial insight information, which is called mean return. Next is a variance and standard deviation. Okay, variance. What is a variance, guys? Variance is the square deviation of a security return from its expected return. Next, standard deviation. Standard deviation is the square root of variance. It's easy, right? Assess volatility, variability of a security return from its expected return. Next is a covariance and correlation coefficients. Okay, there are three situations when a negative covariance, a positive covariance, and a zero covariance. When a negative covariance implies that the returns on one stock is likely to be above its average, when the returns on the other stock is below its average, and vice versa. Second, a positive covariance implies that the returns on one stock is generally above the average, when the returns on the other stock is also above the average, and vice versa. And third, a zero covariance implies that there is no relationship between the return. Remember, when a zero covariant, there is no relationship between the return. Okay, this is the formulas. There are three steps. Okay, this is the first step to how to calculate expected returns or mean return. Is the formula is total P times R. P stands for probability of return, whereas R is an expected returns. Okay guys, this is step 2 to calculate standard deviation. This is the symbol of standard deviation equal to square root of total probability times with expected return minus total expected return and 2 here. And this is step 3, coefficient of variance COV equal to a standard deviation divided by expected return. Don't worry if you guys still not clear with this formula. My friends will talk more about this formula by using some example question. You all must know correlation must always be between positive one and negative one, but sometimes it also can be a zero. So the conclusion is if it is positive one, it means perfectly positive correlated. If it is negative 1, it is perfectly negative correlated. Whereas if it is a 0, it for sure is uncorrelated or zero correlated. Whereas if it is between more than 0 or less than 1, it means positively correlated. And if it between more than negative 1 and less than 0, it shows negatively correlated. Okay, that's all from me. Thank you. And next, I will pass to the next presenter, Nur Shafina, for the next slide.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Shafina binti Muhammad. Thanks to Liana for explanation the formula how to calculate the risk and return for the single asset. These are the example questions that I use. Azari Berhad is considering an investment in one of two company share. Given the information that follow, which investment is better based on the risk and return? This company provide two company, which is company X and company Y. Okay, these are the probability for company X and these are the probability for company Y. The first step that we need to do is to find the mean return or expected return. These are the formula that we use to calculate the expected return. Okay, based on the information that we get from the question, we construct the table just like this. Then we put all the information into the table. There is our information for the company X and these are the information for the company Y. To find the expected return, we must probability times return. Then we get expected return. For example, 0.30 times 11%, we get 3.3%. 0.40 times 50%, we get 6%. 0.30 times 90%, we get 5.7%. Then we add all together. 3.3 plus 6 plus 5.7. Then we get the total expected return is 50% for company X. We do the same thing for the company Y. The total expected return for the company Y is 9.4. Okay, that's for step 1. Let's move to the step 2. For step 2 is to find the standard deviation. Okay, these are the formula. Okay, that we need to use for the standard deviation. Okay, first we need to construct the table and we need to add two extra column. For the first column is return minus expected returns type power of 2. For example, is 11% minus 50% type power of 2, then we get 60%. Next, 50% minus 50% type power of 2, we get 0. Next, 90% minus 50% type power of 2, we get 60%. The second column is we use the formula probability times return minus expected return times power of 2. For example, 0.30 times 11% minus 50% times power of 2, we get 4.8%. Next, 0.40 type 50% minus 50% type power of 2, we get 0. Last one, 0.30 type 90% minus 50% type power of 2, we get 4.8%. Then we add all together, 4.8 plus 0 plus 4.8, then we get total is 9.6. Okay, to find the standard deviation, we need to square root 9.6. The answer is 3.10%. That is for company X. We do the same step for the company Y, which is we get the total is 83.04%, and then we square root, we get the answer is 9.11%. That's for step 2. Next, we move to the step 3, which is to find the coefficient of variation. These are the formula that we need to use to find the coefficient of variation. For the company X, we use the standard deviation divide by the expected return. Okay, we see the company X. The standard deviation is 3.10. The expected return is 50%. Okay, calculate. Then we get 0.2066. Okay, for this figure, it shows that for every 1 unit of return, the company pays 0.2066 risk. For the company Y, we do the same thing. The standard deviation is 9.11%. Divide by expected return 9.4%, then we get 0.9691. Okay, for every 1 unit of return, the company pays 0.9691 risk. So the decision that we need to make is therefore the company can invest in company X because the company X will face the lower risk that is 0.2066. Compare the company Y that is 0.9691 for every unit of return. That's all from me. Thank you.
Hi, I will present about KPAM, which is this is the relationship between risk and expected return from William Sharp, 1964. KPM explains the relationship between risk and required return of an asset when they are held either in a well-diversified portfolio as well for individual securities. Expected return of asset should be positively related to its risk. That is, an individual will hold a risky asset only if its expected return compensated for its risk. Expected return on the market formula is RM equals to RF plus market risk premium, and expected return on an individual securities formula, which is RI equals to RF plus beta in bracket RM minus RF. Now we will proceed to the security market line, SML. At first, it's explain the relationship between systematic risk, beta, and expected return, and also the relationship between risk and return on individual securities. So this is the formula for SML, which is RI equals to RF plus beta I in bracket RM minus RF. So first, the expected return on a stock with a beta of 0 is equal to the risk-free rate, and the expected return on a stock with a beta of 1 is equal to the expected return on the market. So this is the graph for SML, which is the security market line. Now I will explain about the assumption of KPM. First, investors are risk averse. Second, investor maximize expected utility of the portfolio over a single period planning horizon. For example, investors have identical single period holding horizon. Third, there exists a perfect competition, which is the individual investors are price takers. Fourth, securities are completely divisible. Fifth, investments are limited to traded financial assets. Sixth, there is no tax or transaction costs are involved. 7. Investors are rationally means variant optimizer. 8. Investors have homogeneous expectation. 9. Is a risk-free assets are available. 10. Financial markets are frictionless. And lastly, investors have access to all investment and also to unlimited borrowings and lending opportunity at the risk-free rate. Now I will explain about the limitation of KPM. There are 3 limitations of KPM. First, it is difficult to estimate the risk-free rate of return on projects under different economic environment. Second, it is a single period model. Therefore, it is not possible to use KPM for projects which last for more than 1 year. Lastly, complications in decision making cannot be modified easily. Now I will present about the formula of KPM. The formula is R1 equals to RF plus beta in bracket RM minus RF. So RF is the risk-free rate of return. Beta is the beta coefficient of security, and RM is the return of the market. This is the conclusion for KPM. It implies that the expected return on a security is linearly related to its beta because the average return on the market has been higher than the average risk-free rate over long period of time. If you have any question, you can ask us, and that's all from our group. Then thank you. Bye bye.
Pahit hindi